Over the past few years, the world has witnessed rapid developments in technology, drawing significant global attention. Instagram took 30 months to reach 100 million users, while TikTok managed to do so in just 9 months. But what about ChatGPT? It only took 3 months to reach 100 million users. Many people believe they missed out on investment opportunities in the past year. So, what about artificial intelligence? Is it the next big investment opportunity? It's clear that AI is the future.
Let's invest in AI. Put your money into artificial intelligence and it will double within months. It's obvious that AI will lead to an information revolution similar to what the internet did.
Investors, upon catching a glimpse of AI's potential, eagerly jumped in. Microsoft invested $10 billion in OpenAI, the creator of ChatGPT, and OpenAI's valuation reached $30 billion. This sparked extraordinary excitement in the world of investment and business. In January 2023, BuzzFeed announced that a significant portion of its content would rely on AI assistance. And boom, the stock jumped 150%. Soon after, companies started saying, hey investors, by the way, we're an AI company. And if we're not an AI company, we use AI in everything we do. The graph before you, dear reader, shows the number of times AI has been mentioned over the past 10 years. Suddenly, there's a boom in mentions of AI or related terms. A company like Nvidia saw its stock soar by over 400%. On one day, the company's value increased by $184 billion in a single day.
All this talk about investments, billions, and 400% gains got me excited about investing. Shaban, I'm going to put my money in AI companies, benefit from the revolution, and make 400% like what happened with Nvidia due to the AI revolution, or 13,000% like what happened with Tesla because of the electric cars revolution, or 204,000% like what happened with Amazon due to the internet revolution. I want to get rich, Shaban, and make my money grow.
But don't rush. I know you're thinking, like many others, about how to take advantage of this situation. You see a revolution in the tech world happening right before your eyes. But, my dear friend, let me surprise you by saying that the perception you have is one of the biggest misconceptions in the investment world. It's a common mistake, and let me tell you why. In a famous speech by Warren Buffett, one of the greatest, if not the greatest investor in history, in 1999, he talked about the automobile industry. He described it as a revolutionary and important industry that transforms cities and our way of life and continues to do so to this day. Today, cities are designed around the car. The layout of streets and their dimensions are tailored to cars, not your shoes. Warren Buffett shared that if you were in America during the 1920s when this industrial boom was occurring, there were over 2,000 car companies in the US. If you had been as excited as you are now and invested in this great industry, which was indeed going to change the world soon, you might have gone bankrupt.
Wow, Shaban. So the car industry is treacherous.
My dear friend, this is a well-known phenomenon in the investment world, not just in the car industry. We saw it in the 18th century when the British were obsessed with building canals for boats, leading to investment, excitement, and a subsequent bubble and collapse. We also saw it when the British became obsessed with railroads in the 19th century, leading to investments, excitement, and eventually a bubble and then a collapse. We saw this phenomenon in America in the late 1990s when the world became obsessed with small internet companies that were supposed to change the world. People poured in investments and attention, and then we witnessed a bubble, followed by a crash. This is the crash that Warren Buffett predicted in 1999, known as the dot-com bubble burst. For example, the market value of companies like Pets.com plummeted from $300 million to zero. Even a large, well-known and influential company like Amazon lost 95% of its market value. Today, Amazon's value exceeds $1 trillion. Even the Nasdaq index, which includes the most important technology companies, lost more than 70% of its value. Here we are talking about industries of immense importance. The canal industry for boats was significant. The railroad industry, which connected cities and facilitated trade, was vital. The internet industry, which connects the world and makes knowledge accessible and widespread, is crucial. These aren't fake bubbles. But many investment experts advise, don't be drawn to industries that everyone knows are important. Does this information seem surprising? According to Jeremy Siegel, a professor of finance at the Wharton School of the University of Pennsylvania, one of the top business schools in the world competing with Harvard. He states in his book Stocks for the Long Run, if you invest in an industry that declines over time, you might actually make more money.
Really, Shaban?
According to him, yes. Let me explain with an example. In the past, railroad companies made up 63% of the S&P 500 index, which includes the top 500 companies in America. These companies dominated the index, but their presence has dwindled to just 1% by 2019. By all these definitions, it's a dying industry, from 63% at the beginning of the last century to 1%. But if you had invested in the railroad industry, you would have made more money than if you had invested in the airline industry, which was a breakthrough in transportation history. Being able to board a plane, close your eyes, and within hours arrive on the other side of the planet, this is a leap that your ancestors couldn't even dream of. Not only that, if you had invested in railroad companies, you would have made more money than if you had invested in the entire S&P 500.
Shaban, honestly, I feel like you're just stating controversial opinions for the sake of it.
Let me give you another example because I feel like you don't believe me. Let me ask you a question. If we go back to 1971 and I asked you, would you put your money in software companies or oil companies? What would you choose?
Of course, Shaban, I would choose the software industry because it's advanced and will indeed change the world. But oil, it's over, and electric cars will soon replace it.
Let me surprise you by telling you that if you had invested $1 in software companies in 1971, by 2019, it would have returned $74.
Wow, Shaban. See, I was right.
Wait. If you had invested that same dollar in oil companies, the ones the world doesn't like, that the environment doesn't favor, that cause pollution, and that no one loves while people are investing left and right to find renewable energy sources. If you had invested in this old, polluting, unpopular industry, that dollar would have turned into $134 by 2019. That's double what you would have made from software. This brings us to a very important lesson. Successful investing doesn't necessarily mean investing in the highest value, because the highest value, as long as you buy it at a price higher than it's worth, will lead to losses. And the lowest value, as long as you buy it at a price lower than it's worth, will bring gains. So yes, the software industry is important, great, and revolutionary. But its price will be high because everyone knows it's important and ideal and revolutionary, which means its price is higher than its already high value. And industries like oil, which people generally dislike and don't favor, often have prices that remain below their true value. So if you buy into them, you can profit. You, the one watching me right now, if you want to preserve the value of your money or want to invest to grow your wealth, allow me to explain how you can invest to increase your wealth. The first scenario is that you buy an index. Over the past 100 years, it has provided an average return of about 10% per year. This type of investment involves buying an ETF, which is a fund containing many companies. This investment is called passive investing. You don't have to go through the trouble of selecting and evaluating companies. No, you just buy an ETF fund. And that's it. Let your investment grow over time without effort. Most experts recommend that you do this, go for an index, put your money in it, and that's it. The second scenario is that you entrust your money to someone knowledgeable and capable of managing it, like Warren Buffett, who is very good at finding companies whose value is higher than their price. He buys these companies and lets them grow naturally. This man's wealth has grown by about 20% annually on average for more than 60 years. For example, we have a famous investor named Stanley Druckenmiller. This man, for nearly 30 years, has seen his capital increase by 30% on average each year, and he has never experienced a full year where his wealth declined. At the end of every year, this man comes out on top. So this is a possible scenario. You can entrust your money to someone who understands investing. But before we present the third scenario, it's important to note that some investors have a different perspective and believe that copying investments doesn't always work as expected, meaning they criticize the second scenario we discussed earlier. One of these people is Dr. Mohammed El-Erian, president of Queen's College at the University of Cambridge and economic advisor to Allianz. The point, my dear, is that Dr. Mohammed El-Erian believes it's not the best thing to buy the index and wait for better times ahead. He thinks the coming period will be the era of smart money. Another person with the same view is Seth Klarman. Seth Klarman is one of the most important investors in the world. He manages over $29 billion and has a very significant book titled Margin of Safety. Let me tell you that the most important thing you should know about Klarman is that Warren Buffett, the greatest investor in history, says that if he were to retire one day, Seth Klarman would be one of the 3 people in the world he would trust to manage his money. What I want to tell you is that Klarman is very smart and well versed in investing. This man, my dear, has said several times that he is against the idea of passive investing. Not only that, but if we look at reports from companies like JP Morgan, Vanguard, and UPS, they say that the SP 500 won't give you the 10% returns that it has historically provided in the coming period.
Shaban, let me ask you a question. Why are they saying this? Do they have some inside information, or is this just personal opinion?
My dear, as I told you, there's a big debate on this topic. Some people believe it's better to continue with passive investing and others believe you shouldn't. One of the reasons some say don't continue down this path is that companies in the US market are very expensive. To determine whether a company is expensive or cheap, you look at a certain ratio called the PE ratio. This is the price to earnings ratio, meaning the price of the company divided by its earnings. For example, let's imagine a company earns $5 and this company's market value is $100. The PE ratio for this company is 100 divided by 5, which gives us 20. Here, the PE ratio of the company is 20, meaning the company is worth 20 times its earnings. If we took all the companies in the SP 500 and divided their value by their earnings to get the PE ratio for the SP 500, we'd find it's 28.
Shaban, is this expensive or cheap?
This, my dear, is very expensive. Some people see this as overpriced. If we compare this number with the rest of the world, we'll find it's very expensive. For example, a country like China, with all its companies and technologies, has a PE ratio that ranges between 7 to 9. Not only that, if we compare the PE ratio of the US market today with the historical PE ratio of the US market, we'd find it's 15. Historically, the PE ratio of the SP 500 was 15, and over the last 15 years, it was around 19. But now that it's reached 28, it means it's very expensive. Yes, the US market is growing with AI developments, deals, and innovations, but this makes the risk here slightly higher. This is just a simplified explanation you can rely on. But don't worry, my dear, there's money in this, it just requires you to use your intelligence. As for the third scenario, my dear, it's where you invest your money yourself, relying on your own efforts in hopes of achieving higher returns than the SP 500. By the way, I personally adopted this method from 2017 to 2019, and it led me to discover the greatest investment in history.
Did you discover this method yourself, or did you rely on a particular study?
In truth, this method doesn't focus on finding the project itself. It doesn't look directly at the project, but rather at the people behind the projects. In other words, it's a search for brains, not a search for projects. Specifically, in late 2019, just before 2020, I came across a professor named Chong Li, a professor at Columbia University in New York City. Columbia University is one of the most important universities in the world. It was founded in 1754, making it one of the oldest institutions of higher education in the United States. It's one of the most prestigious universities in the US, and is part of the esteemed Ivy League group of universities. Universities like Columbia have brilliant professors with immense intellectual capabilities. Choosing the best and smartest professor from these universities means your chances of selecting a successful project are doubled, especially if these professors have projects or are considering building their own investment ventures. What drew me to Dr. Chong Li, who has now been promoted to the rank of professor, is that he specializes in electrical engineering, network control, communications, and advanced communication technologies like 5G. A professor with these qualifications should definitely be on your radar or shortlist. He's someone who is personally focused on the technological future of the planet, not just on investment. In his book, Reinforcement Learning for Cyber-Physical Systems, published in 2019, he provides a detailed explanation of various reinforcement learning algorithms such as Q-learning, deep Q networks, and policy gradient methods. The book also covers a wide range of applications, including robotics, self-driving cars, and drones. It also discusses the challenges of applying reinforcement learning in cyber-physical systems, as well as the future directions of this field. Misha Schwartz, an expert in electrical engineering engineering, and a distinguished American academic who held prominent positions in universities such as Columbia University, where he served as a professor and chair of the electrical engineering department, once stated, "Communication networks are the backbone of modern society, enabling everything from personal connections to the global economy." Meanwhile, Andrea Goldsmith believes that innovation in wireless communication technology is crucial for enhancing the capabilities of our digital society. These are among the areas of interest for Professor Chong Li, which are highly significant in the worlds of technology and investment.
Yeah, Shaban, are you suggesting that I should look for a doctor interested in communication technology?
Not necessarily. It's not a given that all professors are interested in communication technology. For example, Professor Chong Li is also engaged in electrical engineering, artificial intelligence, Q-learning, blockchain, and other fields. And the professor's area of interest is not the only important factor. There are other aspects related to the personality of each professor that are also crucial in determining whether you've chosen the right person.
Yeah, Shaban, you're saying something a bit odd now. Do you mean we should spy on the professor's life, check out his diet, and what kind of clothes he wears?
Of course not. It's not like that at all. For example, the way a professor interacts with students is an important point, as is his punctuality and discipline at work. I contacted several students from Columbia University just to get their evaluation of Professor Chong Li, and the rating I received was 5 stars. This way, we can be more certain that we're choosing the right person. If we test this theory, which I've relied on for years, we'll find that Professor Chong Li has led a highly successful project. Chong Li has been and still is the founder and CEO of the project and company ComputeCoin, now known as Oortech. He took this company from nothing to a successful project competing with major and well-established companies in the market. When we talk about the success of the company, we're talking about a strong and capable team, including Mike Robinson, Tyler Lockley, Sean Yang, John Kay, Sang Lee, Venceslav, Marian Tong, Mei Peng, Kim Abe, and many others. They contributed to the success of the company, and here we see the touch of Professor Chong Li. He carefully selects his team and puts the right people in the right places. This approach may seem long and exhausting, but it ensures that you achieve higher and more guaranteed results compared to randomly buying shares. I've tried this method and I'm still amazed by the strength of Oort. Today I am part of this company's team and we're achieving significant successes in a very short time. Based on my experience in choosing the best investment, never think about profit. This may sound strange, but it's the best approach. Successful companies focus most of their attention on developing their products and acquiring the largest number of users. Then they receive returns as a result of the service or product they provide to customers. This is how successful companies achieve huge wealth that they would not have achieved if they had focused on money in the first place. Companies like Microsoft, Google, and Oort prioritize the quality of their products and services. In less than 5 years, Oort has managed to attract many important customers and partners such as Dell Technology, BNB Chain, Tencent Cloud, Google, and Microsoft. Oort also has its own network and coin. The Oort coin was launched a few months ago and the price of a single coin has exceeded $1. It is listed on several platforms like Gate.io, KuCoin, MEXC, Bidget, and many more. I believe that Oort's trend will form a cup shape, which I think will see the coin's price soar, easily surpassing $3. If you like this scenario of choosing the best project but don't have the time, effort, or patience to do it yourself, I've done it for you. Of course, this is not investment advice, but it is the best way for me. I believe we are on the verge of a crypto bull season where all market prices will rise, and it will be too late for many who want to enter the market but have not yet found the right project, one that is strong and reasonably priced. Currently, this is available in Oort, but it won't last long. Today, you have the top 3 investment scenarios. Tell me in the comments which scenario you prefer, and also let me know if you want to learn more about Oort.